everyone. Welcome back to Trading Simplified. So, what are we going to talk about today? I want to just kind of jump right into it. We got so much to talk about. Thoughts on setting the initial protective stop, figure out ways to do that, and you go a long ways towards your success. Over the weekend, I'm thinking, like, what am I going to do on my show on Wednesday? And I'm like, oh, I'm going to talk about stops. I'm like, oh man, everybody's going to be so bored with stops. And then I got thinking about it. It's like, well, if you figure out stops, you're really a long ways towards your success as a trader. I'm going to flesh that out in a lot more details. Evidently, last week I accidentally revealed the mystery chart, so it's not much of a mystery. It's MTCH. And not a lot has happened there, other than I think it's still a major top. We'll talk about that next week as time allows. I do have quite a few Q&A. I'm going to try to get through as many of those as possible, but keep them coming. I will answer all questions eventually, and that I promise. And then if we have time, I want to show some of my recent trades. All of them are still actually live, and I want to show how the stops are working out on those. Obviously, I want to thank everybody for coming today. I appreciate you taking time out of your busy schedule, easy for me to say, to be here. There's a disclaimer screen. As you know, you can lose money trading, or as I often say, all predictions are about the future, and a lot of stuff can happen between now and then. That's borrowing the line from my friend Greg Morris. As I've said before, a lot of times I'll do a seminar or present somewhere around the globe, and then afterwards, quite a few people will come to the stage and ask me a bunch of questions about the methodology and setups. And one, maybe two, will ask me about money management. And the reality is, those one or two traders are the one or two that get it. And I realize that money management isn't the most exciting thing in the world, but if you embrace it, it will embrace you. Years ago, when I was in college, there was a tire salesman, a pitchman named Sam Bear. And he would get on TV, just kind of tell it like it is. Tires ain't pretty, tires don't smell good, but you got to have them. And if you got to have them, you might as well buy them from Allied Tire. Well, it kind of reminds me of money management. Money management ain't sexy, but you got to have it. They're sort of the tires of trading. The best methodology in the world is useless without proper money management. Now, channeling yogi, this is what I woke up thinking about 3:30 on Monday morning. I know it's not very exciting I don't have very exciting dreams, but I woke up thinking, like, I am going to do that show on stops because two people literally have asked me about setting stops. And so those two people are those people that get it or assume will be successful. And the more I thought about it, the more important I realized how stops are crucial and how crucial they are in trading. So if you can get your stops right, and of course a little stock selection, that's 95% of the battle. Now the remaining 90%, again, channeling yogi, is you. One thing that I thought about years ago, and there's a much longer story that we don't have time to get into, but basically out of that came money management will cure a multitude of sins. And people say, is your money management psychological or statistical? And my answer is yes. There's a huge psychology involved with setting stops, as we're going to talk to today, taking partial profits and trailing those stops. And I'll touch upon all of that over the next few minutes. But the bottom line is, if you're trading at a proper size, then psychologically it's going to be a hell of a lot easier to follow your trading plan. And also, when you do, not if, but when you do get stopped out on a position, you're much easier to handle it because it's not going to affect your psyche, because you could live with losing a small amount of money on a trade. Now, one thing that's kind of interesting with the money management is I fixed a lot of people for free. And what I mean by that is people call me up and like, hey, Dave, I've been stopped out numerous times in a row. And I'll just say, well, loosen your stops a little bit, provided your stock selection is pretty good, provided you know what you're doing, provided you're following the trend. Then a lot of times you just loosen up your stop a little bit and you'll catch more and more trends. So if you could figure out where that stop needs to be, and again, if you're getting stopped out a lot, it's probably too tight, and we'll explore that in a few minutes. But if you can figure out your stop, not only have your initial profit target, and all you have to do, and I know easier said than done, all you have to do, my wife's always like, not so much now because we have a new house, but when we had this old house, it was always an issue. And she's like, hey, Dave, all you need to do is take your little wrench and, tighten up a little bit. It'll stop that leak. Well, I think I've told the story before, but that's happened over and over where, I do a little and then it just makes this huge mess. So it's never as easy on the surface as it appears. Let me rephrase that. It always looks a lot easier on the surface. But all you have to do, if you can figure out where your stop is, then you know where your initial profit target is. So all you have to do from a psychological standpoint is simply follow your plan. Now, if you think about the noise of a market or the volatility of the market, let's assume that it's like a two-lane highway. As long as you're on the sidewalk, you're going to be okay. You're going to be outside of that noise. So think about the top sidewalk would be where a stop would be if you were short a market, and then the bottom would be where a stop would be if you're long the market. And now, if you're come off of those sidewalks, in other words, if your stop is within the noise of the market, you're going to have to cancel Christmas. You're going to get stopped out, guaranteed. And the same thing again on the long side. So if you think about that highway, in this case, I have a two-lane highway, but you think about that as a noise of a market, you have to be outside of that noise of the market. Otherwise, you're going to have to cancel Christmas. You're going to get knocked out. You're going to have a losing trade. And that I can guarantee. Now, suppose you have a four-lane highway. Well, then obviously, if that sidewalk's in the middle of the highway, then again, you're going to be guaranteed a loss. And then again, you're going to have to cancel Christmas. So stock placement is really an art and a science. And the science, for starters, is you have to be outside of that normal short-term volatility. If you're inside the noise of a market, if your stop is inside that noise of a market, you're virtually guaranteed a losing trade. So I guess the next question is, well, what's the noise, Dave? Well, it depends on your holding period. You need to at least be able to ride out the shorter term noise of the market or the shorter term volatility of the market. Now, the next question is, well, how do you measure that? Well, statistical measurements are useful. Unfortunately, statistics are worthless. 73.5% of all people know that. But seriously, since markets aren't normally distributed, that means that markets don't adhere to statistics. If they did, then whoever had the best computers or whoever knew the most about statistics would win the game. So years ago, there were some option traders that did figure out some things, some models or whatever, and then before everybody knew them, then that worked really well. But the reality is you have to realize that statistics aren't useful. They're useful as a tool, but they're not exacts when it comes to markets. So if you do use some sort of statistical measurements, it's going to be really, really, really large relative to where a little common sense could get you into that stops. Now, I do occasionally look at historical volatility, but I don't use that directly in my calculations. And years ago, I did some historical volatility-based stops just to see what would happen. And statistically, they became just so enormous that it would be impossible to trade in that fashion. Now, all this is going to make a lot more sense as I go through a few charts and diagrams. So again, common sense is really your best friend. Just kind of eyeball the stock or the market that you're trading and see how much it bounces around and determine where you need to be outside of that noise. Now, some questions you need to ask yourself is, how long do you want to be in the position? If you're a day trader, then maybe a fairly tight stop might keep you in long enough to capture that intraday trend. Conversely, if you're a long-term trader and you want to be in trades for a long time, that stop's going to have to be a lot wider. And I'm going to walk through a few of those in just 1 second. The next question is, how volatile is the underlying instrument? And that's the noise. Now, you can use statistical measurements for this, or you could just look at the chart. And then the third question you need to ask yourself is, where would you be obviously wrong? Now, remember, I'm a trend follower. So where would you be obviously wrong as a trend follower? Where would it appear that that trend has turned? So again, the longer you're in a trade, the more time you're in a trade, the wider that stop's going to be. Now, remember, I'm slotted as a swing trader, but I'll stick with a position for as long as it moves in my favor. And the secret sauce to doing that, which we'll get into in a lot more detail in upcoming shows, is via the trailing stop. But I go in saying, okay, how do I make money on a swing trade on this? How far does my stop have to be to ride out that short term volatility? And if I'm blessed with a profit, then I change hats to become a trend follower. And all I do there is, number one, I take partial profits at the swing trade in case that's all I get. And then number two, I slowly and gradually allow that stop to widen out on the remainder of the position to hopefully, and I know I said hope, which you should never say in trading, right? But hopefully stay with that position for a long, long time. People say, Dave, what's your holding period? I say, well, at least 10 years, hopefully much longer. But obviously, the money management takes me out a lot sooner than that. So with the trailing stop, we're going to slowly loosen that trailing stop over time to transition into the longer term trader. Now, there's not enough time to get into it today, but just real quickly, if you're going to be a long term trend follower, your drawdowns are going to be abysmal. Your accuracy is going to be probably about 28% at best. So 72 to maybe even 75% of the time, you're going to be wrong. So I would much rather be a swing trader, but then have my cake and eat it too by keeping a portion of the position on half just in case it turns into a longer term trend. So let's take a look at a big winner from a few years back. You can see that the first loaf, and this is on a hypothetical $100,000 account just to keep the math easy. So we're risking 2% on the position, but that's if stopped out. And as you'll see in a couple examples, that stop may be fairly close to the market, maybe within, let's say, 10%, or it might be as much as 35% or more away from the market. But we're looking to get that swing trade out, 1% gain on a $100,000 account. And then we're willing to stick around just in case that longer term trend begins to materialize. So in this particular case, we had a trend knockout, which we'll get into in a lot more details in upcoming shows. And I'm also going to, if you go to davelandry.com/StockCharts, you can get all three of my books for free. Give me some time to get that set up if you're watching this show live. And then I'll discuss the trend knockout in those books. Anyway, getting back to this. So entry is here. The knockout bar has a stop below the market. And that, if you project that up, the entry minus the stop gives you the stop distance, plus the entry gives you the initial profit target. As that position moves in our favor, we take partial profits, and then we let that stop widen out over time. So you can see that we made 18% on the swing trade, and then we made 152% on the remainder. But Dave, why didn't you keep the whole position? Well, because we didn't know that this would turn into a big trade. This could have easily hit the initial profit target and then stopped us out on the remainder. Now, the other thing you have to ask yourself is, how volatile is the underlying instrument? There's a popular methodology, and I think I've alluded to this quite a few times, that says we should all use an 8% stop. That's like saying we should all wear, a medium-sized shirt. And that's something that my fat butt hasn't done since I was 5 years old. So your stops are going to vary greatly. So looking at a portfolio snapshot from a while back, we were short a bank and we had an 8% stop. Now, banks, as you know, don't move around a whole lot as a general statement. But we were also long a speculative mining company. And on that one, we had a 35% stop. When you look at the chart, it doesn't look like that big of a deal. But it's kind of hard to wrap your head around having your stop 35% away. Now, the first thing you're probably asking is, well, wouldn't trading a lower volatility stock be less risky? Well, the lower the volatility of the stock, the closer your stop is going to be to the market price and the more shares you'll have on. As that stock becomes more and more volatile, you're going to have to be further and further away to ride out that short-term volatility, but you're going to compensate by trading fewer and fewer and fewer shares. So your stop's going to be much wider. Remember I said earlier, a 35% stop, but you're going to take your share size way down. Now, what's interesting is this is not the amount you have risk, but this is the amount of margin you have put up on your account. Notice that drops significantly as the stock gets more and more volatile. So let's say the stock gets a 50% haircut and you have a very tight stop, which means that you have a large amount of shares on. Well, that could maybe hit your account for a nearly 50% loss. Whereas if you get hit pretty hard in a very volatile stock, then that might only be a 5% loss based on where your stop is set. So I'm making the case here for trading more volatile stocks, just trade fewer shares in them. Now, you have to remember that something bad can always happen, even in a stock that appears to be safer or lower in volatility. So when it comes to trading stocks, I like more volatile stocks. I feel like it's better the devil you know. And also, the more volatile stocks have better potential to move over a short period of time so you can get that swing trade out. Okay, we're going to take a quick break and we'll be back in a few seconds to continue talking about stocks.
Today's market volatility provides savvy traders and active investors with an abundance of profitable opportunities. At the Traders Expo Las Vegas, November 7th through 9th, over 75 of the most respected traders in the world, including Dennis Gartman, Tom Sosnoff, Todd Gordon, and Tom DeMark, will explain how they're adapting their strategies and share the specific trading opportunities they've identified in equities, options, forex, futures, cryptocurrencies, and more. Claim your free pass to join them at tradersexpo.com.
Okay, let's take a look at where stops are set based on the percentage at risk. So in a case like this, we have a very volatile mining company, and if we divide it out, we're risking 34% on the trade. Now, I know that sounds crazy, but that's what it calls for, and that gives us initial profit target. If you add that to the entry price of $12.30. Now, I remember when I recommended this particular trade, but this has happened quite a bit over the years. But it's like 30-something% stopper. I can't use no 30-something% stopper. And it's kind of like from Caddyshack. I ain't paying no 50 cents for no Coke. Well, then you ain't getting no Coke. So this turned into one of the biggest trades of the year. In fact, most of the time, a lot of our more volatile stocks turn into our greatest trades of the year. And a lot of people just feel like they can't trade them. Well, you can trade them, even if it's a 30-something% stop, you can trade them by reducing your share size down. Now, over time, we do widen that stop out even further, and that's an attempt to capture a longer-term trend. So you can see at the time the snapshot was taken, this stock was up over 128%. Again, we were looking for that initial profit target to be the same as our initial risk, so it was right around 35%. But longer term, you see this stock ran up triple digits. So that stop widened out over time. So you need to first, when setting up initial protective stop, you need to say, where would I be wrong as a trend follower? Okay, if it starts going down and going down enough to where it's no longer a trend or the trend may be busted, then you have to think seriously about getting out. Now, one good way to illustrate this was through a pattern such as the first pullback after a base breakout. I'm a big fan of a big base in a stock and a stock taking off and then looking to trade that first pullback. But if that stock pulls all the way back to the base after you get in, you know that you are wrong. I don't guess you guys remember when you used to say that. Now, let's say you're trading a transitional pattern. We talked about transitional patterns a couple of weeks ago. And basically, you're looking to get into an early trend after a market hits new lows. Well, if it starts going back towards those old lows after you get in, then once again, you know you are wrong. And the same thing goes for something like a bow tie pattern. You guys go back a couple of weeks, we talked about bow tie. So if that stock drops back towards the old lows, you just have to get out of the way because you are, once again, wrong. Now, the hard part is in a pullback because you never know whether or not the correction is over or not. And that's where it becomes a little bit more trickier. And that's where you have to really look at the volatility of the market and decide where that stop's going to be. And something like a TKO, sometimes you can put it right below the low of that knockout bar. But in a generic pullback, it's a lot harder to figure out where you're wrong. Now, as a general statement, if you're trading a shallower pullback, you don't know if that correction is finished. So your stop's going to have to be a little bit further away. And sometimes you get lucky and you have a deep pullback, and it's so deep that if it keeps dropping, you know that you're wrong. So you can maybe use a little bit tighter stop. In other words, that market is more likely to revert back to the mean in the direction of the longer term trends. There's a good chance that you could be able to use a slightly tighter stop on that. Now, sometimes a deeper correction also could turn out to be something more than just that, which is a great thing. Is if you're using an entry, the market will continue to implode and no capital is put into harm's way. So here's some thoughts. Again, eyeball it. If it's bouncing around 3 or 4 points a day or over several days, then your stop better be greater than 3 or 4 points. How many lanes are in that highway? And here's the thing, don't overthink it. And if you are getting stopped out a lot, or if you're not sure exactly where to put the stop, err on being a little too loose and just trade fewer shares to compensate. And again, the depth of the pullback, and then sometimes you can have what I call a textbook TKO, where your stop can go in pretty close to the lows. And if we have time, I'll pull up an example or two of that. Now, the other thing I ask myself is, what's the least amount of room that I can give this position and have it still work? And then again, I do use HV, which I'm going to work with StockCharts to get put into StockCharts as soon as possible. But I do use historical volatility. And if it's really, really high, such as triple digit HV, then I know the stock is very crazy. So I'm going to have to use a very, very, very wide stop, or maybe I'll just pass because the volatility is just too crazy. So again, common sense is your best friend. You're getting stopped out a lot. There's only 1 or 2 things or some combination thereof. Your stops are too tight, or you might need to go back to the drawing board and your stock selection might need a little improvement. Now, I talk all the time about how crucial money management is, but sometimes a good offense is often your best defense. So you want to make sure you're picking the best stocks in other markets to trade going in. Is this really the best setup you can find? Have you exhausted all other possibilities? And then one of those possibilities is doing nothing. So think really hard before putting capital into harm's way. I know it's cliche, but you really need to pick the best and leave the rest. If a stock looks like an electrocardiogram, then you need to pass. And there's a psychological reason why people are dealing or willing to deal with mediocrity in markets, but look for perfection in the rest of their lives. And we'll dig deep into that when we get into psychology. So as I learned early in my computer days, garbage in, garbage out. If you're picking the best going in, you're less likely to get stopped out. So again, pick the best and leave the rest. I said one day I'll do a presentation without quoting Ed Secoda from Market Wizards. Today is not that day. You need to recognize intuition from intuition. And believe me, I work hard at that every day. If you figure that out, please write me a letter. All right, speaking of letters, we got a few questions. Let's get to as many of them as possible. And again, we're going to eventually answer them all. So the question is, what's the difference between RSI and SPX? So I don't actually use RSI, but in answer to your question, one compares itself via the formula, and the other compares itself to the other one. So just a real quick chart here. So if we plot the SOX and the SPX on a chart, and we plot the SPX colon SOX underneath, you could see that when the SOX is underperforming, it drops, and when it's outperforming, it rises. So if you were to just put an indicator on one of these, it would compare its performance to itself. But when you put it as SPX colon SOX or whatever you want to compare it to, it's comparing it to the other instrument. So hopefully that makes sense. The question is, how do you plot? Somebody asked, how do you plot more than one thing? You go down here to where it says indicators and just choose price, and then decide on what you want to plot underline for the underline. Question is, do you ever use options to either argument or replace the stock trade types, sell, stops, limits, etc.? You describe here. Yes, I did a presentation on that just last week. If you go to my website and you click on more trading lessons, it was Dave Landry's The Week in Charts. Should you open that can of worms? Now you will have to register. If you did go through the link, www.davelandry.com/StockCharts, then you have registered and you should have a login that allow you to access the more recent more recent columns and videos. Traded TSCO down to support when I think you pointed the chart out. Made nice many. Thanks, Dave. Well, you're welcome. And Jack said he created a bow tie scan. Oh, I would like to say, please share it with everyone or share it with me, and I will forward it over to StockCharts.com to put that into the system. Okay, I want to show you just real quick how we set stops recently. So AUI, we talked about this one a couple of weeks ago. It was a TKO. We were able to put that stop fairly close below that TKO low. And so far, so good. So far, we haven't been stopped out, knock on wood. And our initial profit target is way up there at 420 if you add the entry to the stop. So again, we were able to put that stop fairly close because we had a bit of a textbook type of TKO. On this particular stock, we had a stop way up here. And my thinking is, well, if the market goes all the way back up close to the new highs, as I showed you earlier, then we know that we are wrong on the trade. Now, one more real quick, TSCO, Tractor Supply. We talked about this one quite a bit here. As a short, my thinking was, again, if it got close to its prior highs in here, then we know that we are wrong on the trade and we need to get out. And ironically, it did get pretty darn close on its way back to new highs. Okay, that's it for this week. Again, I want to thank everybody for coming. Thank you so much.